You no longer need 20% down to buy a $1.5 million home. That's right, the rules have changed for down payment, and in markets like Vancouver and Toronto, this is a huge deal. Until now, if you wanted to buy a home for $1 million or more, you needed 20% down. That means $1 million would be $200,000 you needed to put for your down payment. That shut out a ton of buyers, but as of 2025, the federal government changed the rules around minimum down payment for insured mortgages and increased the insured mortgage cap from $1 million to $1.5 million. And this is opening doors for buyers all across the country. So here's what's changed. Before, if you wanted to buy $1 million or more, you needed 20% down, and that would not require any mortgage default insurance. You weren't even allowed to get mortgage default insurance. Now, homes up to $1.5 million can be insured, and you can purchase them with less than 20% down. You need anywhere from 5 to 10% down now. The way the down payment works is it's going to be 5% on the first $500,000 and then 10% of the remaining purchase price. So let's break down how this would actually work. Let's say you wanted to buy a $1.2 million home. You need $25,000 on that first $500,000, and then on the next $700,000, you need 10%, so $70,000. So the total down payment would be $95,000 on a $1.2 million home. Previously, if you wanted to buy the same home, it would have cost you $240,000 down. So before, you literally needed double for a down payment than what you need now. Now, the main downside to purchasing a home with less than 20% down is that you do have to pay for mortgage default insurance. This is an insurance for the lender. It's not actually an insurance for you. You're essentially paying for them to make sure that if you were to not make your mortgage payment and they needed to take the house away and sell it, and for some reason they couldn't sell it for enough to cover their losses, that insurer would cover the difference for them. Now, this insurance premium can be quite substantial, and that's why you have to determine if it makes sense based on your unique situation. If you can easily save up 20% in a very short time frame, it's probably not going to make sense to put less than 20% down and pay this default insurance premium. But if you're in a situation where it might take you 3, 4, 5 years to save up that amount, then yeah, it might make sense to just buy with less than 20% down, because at the end of the day, that home's value could very well go up more than that default insurance premium in that same time frame. So how much is this mortgage default insurance premium? Well, if you're putting 5 to 10% down, it's going to be 4% of your entire mortgage amount. 10 to 15, 3.1%, and 15 to 19.99% is going to be 2.8%. And then obviously, once you have 20% down, you no longer have to pay this. But it's very important to understand that if you were to sell your house, it's not like you're canceling that insurance. It's already been paid. It gets paid up front and rolled into your mortgage. So who do these new rule changes really apply to? Well, it's going to be for first-time home buyers, for repeat buyers, and for newly built homes. And I said repeat buyers because a lot of people think in order to buy a house with less than 20% down and get an insured mortgage, you need to be a first-time home buyer, and that is not the case. The only rule is you have to intend to live in the property. Now, who this doesn't apply to is rental homes, vacation homes, and alternative lending, as they often require a higher down payment. If you do plan on going with an alternative lender or a private lender, there are going to be different down payment requirements that I'll touch on very quick. If you're going with an alternative lender, you need to have 20% down no matter what. And this would be for people that have bruised credit, or maybe they just need a bank that's a little bit more flexible with income. Oftentimes, these lenders can be fantastic for people that are self-employed and save them a ton of money overall by not having to pay as much income tax and then just have a slightly higher mortgage payment. Private lenders, on the other hand, they're going to require a minimum of 25% down. Private lenders do not look at income or credit. They're typically for situations where you need to get out of trouble, you need to consolidate debt when you don't qualify, more often for people that already own homes rather than buying homes. So a little bit of a recap, you can buy a home all across Canada up to $1.5 million insured if you intend to live in it. That means you do not need 20% for your down payment. You can get in with as little as 5% on the first $500,000, 10% of the remaining price. When you are purchasing with less than 20% down, mortgage default insurance will be required at the tiered pricing, 4% for 5% down, 4% for 5% down, 3.1% for 10 to 15% down, and 2.8% for 15 to 19.99% down. You can only get an insured mortgage on owner-occupied homes, and you are now able to get a 30-year amortization on your insured mortgages. So you very well might have been priced out of the market before. This could be your window of opportunity. There will be a call booking link in the description. If you want to have a chat, click that button, pick a time that works best for you, and we can go over all the different options that you have for your unique situation. And if you have found this video helpful, please hit that like button, subscribe, and ring the bell to be notified. It really does make a difference, and I would really, really appreciate it. Thanks a lot for watching, guys. Catch you in the next one.